Hey, welcome to your Mortgage Insider Update CPI report coming out on Thursday. So we're going to dive right into some thoughts about the CPI. So this graph gives us a history of the CPI since June 2021. So this is going back about 18 months. We've got month-over-month CPI readings. Okay, so what we're looking at right here is we get into the end of 2022. We're both in August, September, then October, November, a drastic drop in the what was higher, 0.6%. But if we took an average, we're definitely below the average on month-over-month CPI numbers. Now, consumer price index, the core rate of inflation, currently at 6%. This was the last report came out in November. That was 0.2% lower than the month before. So it was 6.2 in October and dropped to 6.0. So Thursday this week, we're going to get the December consumer price index. That number is probably going to have a core inflation number of 5 handle. And the lower in the fives, the better. 5.6% would be an incredible number. That would be 0.4% lower than it is right now, which would be pretty awesome because what we're doing is we're replacing December of last year. So last year was 0.6%. And so we look at year over year number, that's this 6% year over year is a function of replacing the prior year's number. So when 0.6% in December 2021 was posted, if we get let's say a 0.2%, just like in November, a 0.2% drop in month over month, that would create an annual drop of 0.4% from December of 2021. That would be a huge drop, and that would bring our core inflation at around 5.6%. The Federal Reserve is already talking about that their view on inflation is that they need to get that back to a 2% number. And if we use CPI, we're way above 2% annual rate of inflation. But the faster we go down, the faster we get to a critical level that's similar to their federal funds rate, which is currently sitting at 4.5%. So at 4.5% right now, if they go up, let's say another 0.5% in late January, early February, their next meeting, that would be a 5% rate of the federal funds rate, the overnight rate. That would be pretty darn close to the rate that we're running in inflation. The closer that they get to that, the sooner that they will slow down their pace of rate hikes. So with that little update, jump into the rates this week. So universal mortgage-backed securities are up today. Up, green is good here. The price of the mortgage-backed security has faltered in the last couple of days. At the beginning of January, has since taken itself back up above the 25-day, 100-day, and even the 50-day averages. The next level to try to breach is the 200-day average. That would just be on a 200-day scale. Let's look at a year. That would be quite a bit higher. That would be an improvement that would take rates back to where they were when we had our early September rally. The 10-year, a little bit clearer, just simplistic way to look at interest rates. The 10-year interest rate is not mortgage rates, but it gives us a very similar overview of the direction of rates. So if we go to the last year, we've probably felt that interest rates are higher since January 2022. Now, we definitely are there was our peak. We're trying to get back into the levels that we were back in September, like right in here. That would be a level just below where we are right now. So if we just zoom in a little bit closer to give us a short-term outlook, as we approach the CPI number tomorrow, the 10-year Treasury is hovering just below its 25-day average and 100-day average and 50-day average. So it has room to fall to close to that 200-day average, just like I mentioned. So if we take this back to September, that would put us in a very pretty spot. That would take us back a considerably amount lower in interest rates, probably get us back to the low 6s, maybe even see a 5 handle on 30-year mortgage rates. One could only hope. All right, so there's your good news for the start of January. Make it a great week.